Hello, everyone. My name is William Mucker. I am a client executive with Camaplan, and I would like to thank you all for joining us for today's webinar, The Peter Thiel Effect, How to Build Tax-Free Generational Wealth Through Private Equity Investments Inside Your IRA, with Charles Harris, CEO of Wealth Our Way. As a quick note, please be aware that Charles will be answering questions at the end of the presentation. However, feel free to use the Q&A function on your screen, not the chat, to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, I do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals, to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'll pass the controls over to you.
Okay, thank you. I'm going to get ready to start the presentation. Charles, are you ready?
I am ready. Thank you, Renee.
Okay.
So hello, everyone. Welcome and Happy New Year. I know we all get tired of hearing Happy New Year every time we're greeted from someone new, but I guess it's historical tradition to do so at least through the end of January. So Happy New Year. My name is Charles Harris. As you can see in quotations, I'm affectionately known by many as Tank. So I have a history of saying Charles Tank Harris, but the name is Charles Harris. I am the founder and chief executive officer of a financial literacy and planning platform called Wealth Our Way. And I was tasked to bring an exciting yet intricately confusing ideology to the audience today. And I plan on doing that as best as possible. It's basically an expansion on Peter Thiel's mega Roth IRA, which has made the news for being able to be a vehicle that was meant to allow middle income Americans the ability to save for retirement tax-free. And yet this brilliant man found a way to put an investment in there that would grow to over $5 billion. And we are going to learn today for how to teach you to build tax-free wealth through private equity investments inside of your IRA, and affectionately known as the Peter Thiel Effect. So I didn't know that I was going to have the benefit of having a disclaimer put up by Will, but we have our own disclaimer here at Wealth Our Way, and I won't bore you with the reading of it. It pretty much surmises what Will said. I am not here to sell you an investment. I'm not even here to promote this strategy. I'm here to give you information on what other business owners and investors are doing inside of their qualified self-directed IRAs. And at the very bottom of this, it says, please consult with your individual financial professionals when you pursue any strategy. I have a saying that I've coined from another advisor that personal finance is very personal. I'm going to give you high-level, broad-based information today. Your particular circumstance and situation may not match up with what I'm speaking on, but it should open a dialogue with your individual professionals. So let's talk about Mr. Thiel and what happened in 1999. The whole genesis of this mega super Roth IRA actually didn't start out to be such. Peter Thiel's a anti-tax person. He, like many wealthy Americans, he actually lobbies very vehemently to Congress and the House about lowering taxes and finding a way to not overtax those who have accumulated wealth through their academic or entrepreneurial pursuits. In 1999, he had started a little company that we all know well now, which is PayPal. And he wanted to find a way, he thought it was a good idea to take his low-cost shares that he was going to get granted in PayPal and put it inside of his traditional IRA. So at the time, he was working with a company called Pensco in California. And the founder of Pensco, Tom Anderson, said, hey, you know, great idea putting low value startup stock inside of an IRA, but are you familiar with the Roth IRA? And ironically, I got my start in financial services in November of '97. So I literally was just getting into the financial services business when great Senator Roth from Delaware got the Roth IRA passed. And it's funny, after doing research for this presentation and familiarizing myself with some information that I hadn't even known of, I recall how the Roth started out as a $2,000 contribution vehicle. And I remember the hard lift that I had trying to convince my clients to put $2,000 into either their Roth IRA or their IRA, keeping in mind that at that day and time, I was working at a firm where the minimum investment was $250,000 to invest at my firm at the time, Smith Barney. So with the group that I was in, and telling them to put $2,000 aside in a separate account, they laughed at me. My clients could not see the value down the road of putting such a small amount of money away. Now, we all know that every year almost every year they index the amount you can contribute to an IRA. And now we're up to $6,000 as of 2022, and catch up allows for another 1,000 after age 50 and above. But back then, to have the foresight to want to put your stock that was trading at 1/10 of 1 cent into an IRA was pretty forward thinking. But getting the additional information from the founder, Tom Anderson, to utilize the Roth, which had just came into prominence and just come into establishment, was an even better explanation. Now, I do know from this platform that we're on that everyone here has a self-directed IRA. I'm not sure the ratio of self-directed traditional versus self-directed SEP versus self-directed Roth. One of the points I wanted to highlight is that this presentation is directed to the Roth IRA, and there are many ways to get there, as I'm sure a lot of you know, if you are above the income limits. Ironically, when Peter Thiel, who's a very wealthy person today, when he established this IRA, his income was only $73,000 thereabout, and he was under the income threshold to allow himself to do that. In this day and age, for people who are above the income threshold for the Roth IRA, we do have the ability to do the backdoor conversion and still get the benefit. The reason the Roth is going to be the focus of this presentation, not that you can't put private equity investments of very speculative startup firms in a traditional IRA. It's just that giving up the ability of capital gains versus, personal income tax rates after this has worked, if it did work, if you pick the unicorn at 10x, 20x, you would probably look at yourself as having lost the tax gain if it was taxable in the future. So these types of plans and strategies, when you're dealing with startup equity, work better and truthfully work primarily through a Roth transaction. Next slide. So we love our government, and we're all Americans. One thing about the IRS is the code is meant to be utilized by those who are intelligent and resourceful enough to utilize it. But the IRS does not like losing. And as they see their codes manipulated to the benefits of others, they tighten the code and they make changes. So in this particular instance, when it came to what they saw happening with private equity investments of startup firms being placed inside of IRAs and just shielding themselves from hundreds of thousands to millions of dollars of taxes, they quickly came up with a list of prohibited transactions. And the number one thing that they prohibited was doing business with disqualified persons. And that's going to be a lot of what I speak to today. I want to pause here to make a broad statement. The information that you're going to be given today is very high level. It's meant to be followed up with questions. We're going to have a Q&A at the end, so take copious notes. The other part about the presentation is that the laws are ever changing, especially tax laws. And what wasn't feasible in 1999 is feasible today, and vice versa. So when we get into the different, what makes a person disqualified or an entity disqualified, I want you to keep in mind that everybody's circumstance is going to be slightly different. What you really want to do whenever you're looking at anything that affects your taxes is resort to the IRC, the Internal Revenue Code, and this particular list of transactions is covered under Section 4975. The major rules that were put in place to restrict these transactions. To speak in layman's terms, what they are trying to avoid is someone having their own company, putting their own stock into their own IRA. And the best way that they've been able to do that was to make an expansive list of qualified persons, which we'll cover on a future slide. But what I do want to say about the penalties when you are caught and found to be in error of this particular code portion of the tax code, the penalties are very aggressive. They're designed to be extremely punitive. They're designed to make sure that you don't do this again. One of the things that I tell people who venture down the path of being very creative with the IRS is make sure that you carve out a certain portion of your monies that you want to try a strategy with. Don't expose all of your money to penalties. What you will find in the planning section of this is that if you take $1,000 of an IRA transaction, but your IRA is worth $2 million already, if you took $1,000 and did something that went against the IRS's code, they're going to penalize the whole $2 million entirety of your IRA. So you do want to segregate any funds that you're going to try any of these strategies with, because if you're found to have been in error, then they will only penalize that portion of the funds. Let's move on to the next slide. What is a disqualified person? This is a very detailed list. You can get guidance in that same section of the IRC 4975, but in specifics, Section C1, subset A. And do realize that besides for individuals, companies can also qualify as disqualified persons. So I'm going to give you the list of disqualified persons per that section of the IRC, but I would ask you to also just read through to get a better interpretation. So the very first person who is considered disqualified when it comes to being able to work inside of the prohibited transaction list is the actual IRA owner themselves. So each of us who owns a business, who has an individual retirement account, self-directed or not, we are not allowed to do business with ourselves as the entity. We are disqualified. Any fiduciary who has responsibility over an IRA is also disqualified. So for people who are bright enough to have created a trust and say, well, I'm not the person, the trustee is doing it. The trustee has fiduciary responsibility over the IRA and is also considered a disqualified person. Your spouse, your ancestors, and this is an interpretable word, ancestors, but basically they mean anyone that preceded you in lineage. So your mom, your grandmom, your dad, your granddad, straight up that line. And then the other direction, any lineal descents, your son, your grandson, your daughter, your granddaughter. If you look at that y-axis in your mind of yourself at the center and anybody above you in relationship to you, anybody below you. And then you go left to right, your brothers and sisters. Most people say, well, that's everybody, but it's not. You can use cousins, you can use stepbrothers. And once again, I see in my business, people basically coming to me, we work as a team. I work with them, their accountant and their attorney, and we're just spitballing ideas of what might work. I'm going to show you some clear-cut, clean ways to do this process or to pursue this process that don't draw IRS muster. And then I'm also going to show you some of the ones that people have brought up that are arguable. And if you're that type of person who says, hey, I'll take my chances, the gain is worth the possibility of getting slapped on the wrist, I'll show you the questionable ones as well. Any business that you or any of the people that I just named, your spouse, your ancestors, your lineal descent, any business that they own more than 50% of is a disqualified person. Any person owning more than 10% of that business is a disqualified person. And lastly, any person who makes more than 10% of the wages of that company is a disqualified person. Maybe a little hard to follow verbally, but as I said, you should look at this list for yourself. When you're staring at this list on the IRS's website, what you will see the IRS, we say there's a difference between the letter of the law and the spirit of the law. The spirit of this law is the IRS is trying to make sure you have no control over any entity in which you would take their private stock and put into your IRA. That is the very spirit of this. So once we know that spirit, we now can work in different areas of trying to get, quote unquote, around or into the gray area. Next slide. So the thing about loopholes are they are meant to be exploited. How can we work in such a way to not be in violation of doing a prohibited transaction with a disqualified person? Here is one very, very creative loophole that for a lot of us who are small business owners already, we may think, well, that boat has sailed, but I would challenge you to be a little bit mentally creative. If you have not funded business yet, you have not formed it, you have not capitalized it, the IRS has deemed through several tax court cases that business doesn't exist to actually be deemed a disqualified person. So it's a situation where you can't do harm to something that doesn't exist. And if that's the case, then you can own 100% of the stock in any company that hasn't been formed before you're willing to make the IRA investment. That is the flagship loophole here. So giving you an example, because as I said, I'm sure I'm speaking to an audience of many established business owners. Doesn't really help you to hear that language, although there are other parts of this slideshow that will be helpful to you. But here's what you are able to do. You can start a subsidiary of the business that's in existence. And before that subsidiary starts, you can completely fund your IRA to purchase its privately owned stock. And we'll get into evaluations later on. And you will make you'll not run afoul at all with the IRS tax code because you funded the business before it got started and got up and running. Now, the part to be careful about, there are post-funding requirements that you must avoid to not backdoor yourself into being a disqualified person. But you are able to start a brand new entity, even if that brand new entity is in the line of work and expertise that you already profit from. Another way, which is one that I like a lot better, and I'll talk about toward the end of the presentation when I talk about why I think cannabis is such a great space for these strategies, is to create what I have personally deemed a co-op business structure. Going back to that list of disqualified persons, recall everybody on that list that was disqualified was either a family member or a shareholder or an employee of a business owned by a family member. So the very first thing that jumps off the page when you look at that list is, maybe I need to be doing this relationship with someone who isn't a family member. Now, there are pros and cons to that. I argue that for as much as you can find a trusted confidant to do a business structure like this with, that you may argue, oh, I can't trust them and they may run afoul with me. I argue that same liability exists with a family member. In fact, I'll speak personally for myself. None of my brothers, I have two brothers and I have a sister. None of the three of them were in my wedding. My wedding party was all my friends, like people I went to college with, people I did business with. It's just to say that I'm a little closer to them than my siblings. So with that being said, are we looking to put ourselves in a situation where we can have freedom of operation without worrying about the IRS scrutiny, but still accomplish what we want to accomplish, which is to fund our IRA with our company stock that we believe in, because if we didn't believe in, we wouldn't have invested our blood, sweat, and tears in our company. Also, if you're looking at a company outside of your own, if you know your golf buddy or your vendor has a business that they're starting up, that they have solicited funds from you to invest in, there is a perfect opportunity for you to derive that relationship under the auspices of your IRA, because you have no familial relationship with that person. The co-op structure works best when it's two ways. When you have talked to when person A talks to person B, you both decide that you're starting an entity, and then you both decide to own the other entity's private stock. If the businesses are in the same area, you can exercise a modicum of understanding. I'm going to avoid the word control, because we'll see on a later slide that control is a huge no-no in this process. But you can exercise your expertise in helping the other person run the practice, because it's basically the same type of practice that you run, just with different ownership structures. And then the last way, which is probably the one that I would recommend the least, because this is the one where you do end up in tax court arguing your position while the IRS argues against your position, is working to skirt the disqualified person's dilemma. And once again, how do you work to get around the disqualified person's dilemmas? You use family members that are maybe one line removed from your lineal descendant list, cousins, stepbrothers, aunts, uncles. And in some of those instances, because they are not on the disqualified person list, people think they're greenlit to move forward, ultimately finding out that their relationship that they have with them still leaves them in control and creates a problem and creates a prohibited transaction at a later date. Next slide, please. This is a very important element, and we look back at the Peter Thiel example. How do we value a private equity investment? There is an IRS notice 2004-8 that covers abusive Roth transactions, and it gives guidance in this area. The number one thing that you want to look at is, are you valuing the equity at fair market value? This is, I could stay here for the rest of the presentation, truthfully, because as you know, when you're arguing in any gray area, when you're arguing in anywhere, especially in a court where it's a subjective argument that gets judged one way or another, beauty is in the eye of the beholder in a lot of instances. There is no, your stock is not traded on one of the major platforms. It's not NASDAQ. It's not Dow Jones Industrial Average. It's not S&P 500. It's not Russell 1000. It's a privately held stock. And in most cases, it's pre-revenue. And in some cases, besides for your funding of your IRA, it's pre-money. And those are, as you know, as a business owner, if you've ever tried to raise equity or value your business or get investors, that's where you get the most flexibility on telling someone how much something is worth. You may go outside of your house and tell people they can invest $100,000 in your business and get 15%. And then by dinner time, run into another person and tell them that same 100,000 you're willing to let go for 20% of your business. You know, they've all of a sudden got a better deal. As long as you can support the fair market value argument, there isn't a lot of resource or precedent available on the IRS to fight this part of the argument. This is where a lot of high net worth individuals who have ended up in tax court for other areas of a listed transaction or a prohibited transaction, they've won this area. This area is still a taxpayer advantage. Trying to determine how much the stock of your company is very subjective. What I will say, there are certain ways that people do transactions, and they're called value shifting techniques, where it doesn't matter what you have valued your stock at. If you are purposely trying to delay taxation, avoid taxation by moving the ownership of a value, something that's valued at A, and changing the value of B when you to B when you move it, that is going to be seen as value shifting. And the going back to my words about the penalties here being aggressive and inclusive and punitive, there's another little side of this that most people don't realize when they run afoul with their IRA in these tactics, is that any money that you put into your IRA where you undervalue the asset that you purchased, when they value it the way they see fit, when they bring it to a higher value, it could take you over your contribution limit for your IRA. And for anyone who has accidentally or purposely contributed more to their IRA than they should, they know there's an excessive tax on that. And that tax goes to everything that's in the IRA, not just the contribution itself. You voided the IRA until you pull that money out to bring it back to the proper contribution level. Next slide. So there are many potential landmines in this process. Some key ones to avoid. Accidental compensation. What do I mean by that? Accidental compensation is when you say to yourself, I'm not going to pay myself a salary. I'm not going to take a draw. I'm not going to bring any money, any financial compensation out of this practice that I am dealing with, because I don't want to be deemed to be working there and violate the whole making 10% of the wages thing. But if you are an expert in a particular field, if you are a practitioner in a particular field, if you have experience and history in a particular field, and you put hours, time, sweat, which is the term that they use in the IRS, the sweat equity, which we know very well as business owners, if you put these resources into an entity that you own inside your IRA, you are considered to have now earned your stake in the IRA through sweat equity. That is considered compensation, and that will immediately make you a disqualified person if that compensation exceeds 10% of the compensation of the entity. And in most instances, especially with a startup entity that you funded with $7,000 or some form of a conversion or rollover, the compensation is not going to be high enough to make your sweat equity not exceed 10%. So you want to be very, very careful that your involvement in the company is very cursory. It's very outside you're not running the company. You're not the person or resource that the company relies on to get the day-to-day business done, because all of your efforts will be deemed sweat equity and will fall under accidental compensation. The second thing, which probably happens as much, if not more than the first, is keeping control. Almost every entrepreneur I know became an entrepreneur because they want to control what goes on in their entity. That's why I became an entrepreneur. And the reality is that if you are deemed to be Geppetto, holding the strings to Pinocchio and controlling the day-to-day activity and the direction of the entity, then you are deemed to have control of the entity. And as such, you now will fall as a disqualified person. And whether you're structured on the board of directors, whether your equity stake is a majority stake, if you are deemed to be controlling the direction of the entity, you are going to fall under the disqualified person category and be on the prohibited transaction list. Excuse me, I apologize. The last thing, and this one is one that I've never seen personally, but in doing my research, I came across, and then I called a couple of CPAs that I know and they've seen it, is failing to pay income tax created in your IRA. So one of the main reasons we use IRAs and qualified plans is to avoid taxation. However, you can owe annual income tax, which of course we know is at the highest rates that we're taxed at, on any profit from a partnership or an LLC that didn't pay corporate taxes. So if the LLC or partnership is inside the IRA, it's not paying corporate tax because it's tax protected. If you are the owner and you're deemed to have done a prohibited transaction, excuse me, you would not only have to pay the taxes for the entity, you would have to pay your tax. You would be doubly taxed because those taxes are due if the partnership and LLC are part of the corporate structure, if any of the investment also is purchased by debt, this comes into play as well. So let me see what's in the, somebody just, an IRA, LLC, and or cannot be managed by the IRA. So I'm going to save that question for the end because we're almost to the end of the presentation and I'm going to open up for Q&A, but I do have an answer for that question. Let's move to the next slide. So what I wanted to do with these next 3 slides was try to give you a summary of the first portion of the transaction, because there's a lot of back and forth between what you can do and what you can't do in those first slides. So this is all the things that you can do, that if you do these transactions, there has been no pushback from the IRS saying that you're creating a prohibited transaction with a disqualified person. If your IRA buys shares from a third party besides the IRA owner or their family members, what does that sound like? That sounds like that co-op I talked about earlier. So you are now don't confuse disqualified person with disinterested party. They both start with DI, but you're a disinterested party to a third party. They just happen to have a company. And this is where I'll also get toward the end of the presentation talking about what the most attractive private equity investments are. Right now, we are seeing what they call a green rush with the cannabis industry. There are a lot of cannabis owners, I happen to work very closely with a cannabis company, who are struggling to find capital because of the banking restrictions and the federal restrictions. And they are startup companies that have penny stocks, fraction of a penny stock, and you are able to go into that third-party investment, get a very favorable valuation, and have no qualms from the IRS about questioning that transaction. What is another way? I touched on this. If your IRA purchases 100% of the shares at the initial issuance or founding of a company, if you do that, unless you end up down the road working in that company and keeping control of it, you are beyond reproach in that IRA investment. You're a startup entity. You can do business with that entity as an IRA owner because the entity itself is being formed and thus was not a disqualified person before you gave them the money. And then this goes back to the post giving the money up. The IRA owner provides solely administrative or managerial duties. And managerial actually should be sliced with, it shouldn't be or, that's a typo on my part. It should be administrative managerial duties. You can't manage the IRA. You can't manage the entity because now you're controlling it. What you can do is manage things like the checkbook. You can, be the person in charge of the bank account for the company, but you can't guide the entity, which is getting ahead of us to that question that was posed in the chat. You cannot manage the company in any way, shape, or form. You cannot have any control. Once you get control of the company, then you are considered a disqualified person. And if you're a disqualified person, it is a prohibited transaction for the company to do business with you, i.e. allow you to own their shares in your IRA. Next slide. Here are some so if we were looking at a green light, a yellow light, and a red light, I just showed you the green light transactions that you can do without any concern. These are your yellow light transactions. These are at risk of running afoul with the IRS, but they're not so open and shut that they're prohibited. If the IRA purchases shares from third parties, while 50% or more of those shares are owned by disqualified persons. To give you the best example of that, imagine buying from your cousin who, according to the disqualified person list, is not a lineal descendant, so we can call them a third party. But the rest of your family are owners of the business, and they own more than 50%. In doing that transaction, people are trying to skirt that they didn't buy the shares from the company that is owned 50% or more by disqualified persons. They're buying from a third party. I would say and provide guidance that is not a game you want to get into with the IRS. The percent chance that you'll be found to be in some shape or form running afoul with the spirit of the law and thus be penalized is probably 60 to 70% of the time. And then the other marginally risky transaction is if the company issues shares to the IRA, but of all the owners that are disqualified under the section 4975 of the IRC, it totals less than 50%. Once again, the letter of the law says you're allowed to deal with a company that has less than 50% disqualified persons. You're going to end up being audited. You're going to end up in tax court where you now have opened yourself up to the possibility of a loss if a judge feels as though you purposely did this to skirt the law. See, the reasons these are at-risk transactions and not strictly prohibited is because you can end up in these situations unknowingly. And the court allows for that. The IRS allows for the fact that you may end up owning shares inside of your IRA in a company that eventually was sold to other family members and now has disqualified persons owning the company you bought, but you didn't do it with malice aforethought, thinking that you were skirting the tax law. It just happened to happen. But if this is now looked at under a microscope from the IRS, and they deem that you set out purposely knowing that 47% of the company was owned by disqualified persons, and you wanted to structure this anyway, your motives will be questioned and you'll most likely lose. The last part is the red light. These are ones that I wouldn't do under any circumstances. These are prohibited transactions. They have case law to prove it. The IRA purchases shares from the IRA owner or their family members. That's the very first thing on the disqualified persons list. You cannot have your IRA purchase shares of your company or purchase your family member shares because you guys are deemed to be disqualified persons. This second slide goes to the part about after you've already gotten involved, you passed the first hurdle, you bought a company before it was founded, you are in the clear, you are in a green light transaction, and then you do nothing but work in the company. You will now be creating sweat equity and you have created a prohibited transaction. If the IRA owner receives compensation from the IRA owned business that they control. Once again, when I'm working with business owners, they tend to be in a pretty good financial situation, and they normally get caught with number 2 more than they get caught with the number 3. Most of them will say, well, I'm earning my money outside of this entity that we're starting or that we spun off. I don't need that entity to pay me a salary. I won't take a draw. I'm just looking for capital appreciation and accumulation of the stock. But then they sit there and they control every vendor and they do all the marketing and they answer the phones and they're deemed to be involved with dealing sweat equity. If the IRA purchases shares from the officers, the directors, 10% or more shareholders, and by 10% or more, I'm saying shareholders who own 10% or more of the stock, or any wage earner that earns more than 10% of the company's salaries. Any of those transactions are prohibited, and you will end up paying taxes You'll get stuck with excess contributions. They'll take more money than was in the IRA. Or if you have a company already in existence, not like the first entity that I described where the company is being formed, this company is already in existence, they issue new shares and you try to buy them or receive them inside of your IRA. Any of those transactions are case law to death of showing you that they are prohibited transactions under IRC section 4975. Next slide, Renee. So the two best articles, the second one is Michael Kitz's. He's a financial planner, financial runs a podcast. I'm not advocating or endorsing that you go out and join. Most of his content, which is just amazing, is free and available via Google search. But the preponderance of the information that I got for this presentation, I want to give credit where credit is due, came from an episode on the Kitz's podcast, investing in a Roth IRA in early stage growth companies without violating prohibited transaction rules. And then if you have any interest in learning how all of this got started and who was the genesis of the mothership of these transactions, of course, I had referenced this Peter Thiel, and ProPublica does an amazing article. It's very long, very in-depth, very detailed on who their sources are, but they're very, very good. The article is called The Lord of the Roths, and there's a subtitle that I couldn't fit on the slide. But if you Google ProPublica, or if you Google The Lord of the Roths, this will pop up. So those are resources and required reading if you're going to go down this avenue at all. Before I get into the Q&A, which I think we have about 15 minutes left till 1, and I don't know how late we go, but I want to talk about, didn't put it on the slide because once again, I'm not here to solicit for any investments that I'm involved in, nor am I here to solicit for the industry in general. But when you look at where most people are finding opportunities with private equity investments at very low startup valuations, of course, you will always have the tech industry. The tech industry tends to have a strong option pool and warrants and other areas that can get you ownership for pennies per share. But the other area right now where there is a lot of need is the cannabis industry. Ironically, I was on a call yesterday where one of the payroll providers for one of the cannabis related companies that I deal with just told me that the company 6 times the expense for their payroll service. They were being charged $6 an employee. They sent them a notice saying that their costs were going up to $36 per employee. And it's known to the industry as the green tax. Any entrepreneur that works in cannabis who is looking for equity or debt from investors, they are paying premiums on their valuations right now because funding is federally prohibited and difficult to come by. So for anyone in the sound of my voice, whether you're hearing this program live or recorded, you should start to look up industry, Viridian Capital Partners, BDSA. You could just, once again, do a search engine for cannabis-related investments and find different opportunities in which to invest a small portion, if you so chose, in those industries, because you would be able to, it's not going to be attractive to pay $100 a share with a $6,000 investment. But when you can pay a penny a share, 10 cents a share, 1/12 of a cent per share into an IRA, even if you just forget converting an already existing IRA or doing large sums of money, if you're just doing a non-deductible $6,000 or $7,000 IRA because you're above the income limits to a straight Roth, and then you convert that to a Roth, and now you got $6,000 or $7,000 to play with. I don't like to use the term play when it comes to money, but if you sought out these types of investors, now I will say that 6,000 or 7,000 may not be attractive enough to get you into the door with one of these companies, but some companies are so desperate for funding that they're taking all comers, and you allow yourself to be in a situation where company ends up being successful. You're looking at a 5 to 10 to 15x investment if it works out. and you're not going to get those types of outpaced returns with your real estate, with your, major indices, things of that nature. So I'll close there and open it up for the Q&A. And I believe Will was going to help moderate through questions.
Yes, Charles, thanks again for that presentation. It was very informative. So we do have a number of questions coming in. I know we're approaching the 1 o'clock time. Now we can go a little bit over that, but I just want to get as many questions as we can answered. But as best as we can. But if any questions are not answered today, again, I highly suggest they reach out to you, Charles, or if it's specifically
Yes.
about their self-directed IRA with Camaplan or anything about Camaplan, please reach out to me or our company. I'd be happy to help. So the first question, it was asked earlier in the presentation. I'm not sure if you want to touch on it more. I know you went over a slide that did touch on it, but if you want to.
Yeah, I just want to expound on it because I can tend to be very wordy, so I want to be very direct in my answer.
Perfect.
The answer for this one is a very clear layup. You cannot manage the company that you own the stock for inside of your IRA. You cannot manage it, which is why I apologize again. And when you clear up that typo on the screen where it said you can be administrative or managerial, you can manage the administrative function of writing checks and things of that nature, but you can have no control at all over any company in which your IRA owns its stock.
Perfect. Thank you for clearing that up. So the next question we have is pretty lengthy. It says, can you have a marketing agreement in a startup company owned in a Roth? This agreement could result in compensation for occasional marketing service or marketing advice. No control over day-to-day operation, more of an advisory role that the company may want to compensate at some time.
So you are asking if you can control the marketing company, but not necessarily the startup entity that you own the shares of inside of your Roth. That is a textbook example of a prohibited transaction. It's actually one that has been tried probably more than others. So your thinking is right on line. Many people have tried this, but it literally in my notes here, I wrote it down word for word, so I'll read it to you. Using your self-directed IRA to invest in and I'm using quotes, management entity or subcontracted vendor does not avoid prohibited transactions, because by extension, what you are now doing, it's a whole nother term that I did not touch on, but it's called self-dealing. And self-dealing is also prohibited under the 2004-8 notice.
Perfect. Thanks for clearing that up. And from my understanding, that lines up with my understanding of it as well. Next question. It looks like it's a two-part question. One, is it a prohibited transaction for Mr. Smith's IRA to buy a portion of a note, say 30%? Two, is it a prohibited transaction for Mr. Smith's IRA to buy Mr. Smith to buy 30% of a note and his son to buy 70% of the same note? I think that's to say Mr. Smith's IRA on the second portion of it.
Right. So, but I would just want to ask a question about the question. Are we asking, is it prohibited for the IRA to buy a portion of a note from an entity that is 30% owned by Mr. Smith?
Yeah, that would need some clarification. Hopefully we can get that. I can't really read too far into that, but there's nothing prohibited about buying notes in general, right, in an IRA. But yeah, as you said, there could be some triggers that would make that prohibited. So a little bit of clarification would help the anonymous attendee that posed that question.
Yeah, and the next one is if the IRA cannot be the manager of his IRA's LLC, would you share the case law backing this fact? So I don't have the actual case that backs that up, but there is a case that it's the Swanson case. Swanson is SWANSON. The Swanson case actually talks about the ability to fund an entity before it starts. And they make reference in the Swanson case that so long as it's the funding, but after the company has funded, you have no active involvement in it, then you don't run afoul of the tax law. So by, disdainment, you could just take out of that language that if you did the opposite, you would run afoul of the law if you are managing it. And then once again, I would challenge you to just search engine the question as you're asking it to me. I'm sure there's a lot of case law. I didn't prepare any cases for this presentation.
Perfect. Thank you. Next question is, can you add shares from the founding company at a later date? I think you touched on this, but
yeah, I think this question was probably asked before I showed that last prohibited transaction. No, unfortunately, you can't. When additional shares are issued, even if you did everything right the first time, once the company is formed, now you become a disqualified person and you can't invest, you can't gain any investment from it.
Thank you. Next question. If I am the manager of my self-directed IRA, LLC, please define managerial and administrative. Can I execute a contract for sale as in a property? Can I buy a property? If not, who has the authority to execute or decide to make an investment or sell an investment?
Great question. The managerial duties, and so first of all, it shouldn't be managerial and administrative, and I've apologized for that typo. It's supposed to be a combined word. The managing of administrative duties is what the language should read. And then that may make it a lot clearer for your question. You can do all things administrative. And if you just think about, I think all of us here are entrepreneurs and run our business. Would you let your chief administrator, would you let your assistant, would you let your receptionist go pick out, find, and close on a property? Most likely not. That's not the capacity that they do inside of your company. However, once you've done all of that, would you put that file on his or her desk and tell them to wire the funds or write the check? Yes, you would. That's administrative work. That's what can be done inside of this particular setup. You cannot in any way, shape, or form govern the actions or direction of the entity if you own its shares inside of your IRA.
Thanks for clearing that up. Next question. I think this is the restatement of an earlier question. If the IRA owner cannot be the manager of an LLC 100% owned by an IRA, by his IRA, would you share the case law or studies backing the fact?
Yeah, that's the one I just had referenced. Now, I will definitely, if the person wants to, I'm not ducking the topic, I'm just saying I didn't prepare for it for this. If you want to email me, I'll work on getting you some case law. I didn't bring it for this presentation because once again, I'm not a lawyer. A lot of what I do is, all of what I do is on the financial side. And then I check with tax professionals and law professionals to make sure that what I'm telling my clients from an investment standpoint or an advisory standpoint is not running foul with the tax law. So I have it on clear authority from accountants, attorneys, that it is illegal, but I do not have a case, but I promise you, if you email me, my email address is on the last slide, tank@wealthourway.com. I will work with you to find the case law.
Thank you, Charles. Next question. I'm assuming solo Roth 401ks have the same rules. Is this correct? From my understanding, prohibited transactions in an IRA, the rules for those also apply for 401ks. Do you agree with that? 1000%
agree, and didn't touch on it. I think in my introductory executive summary for this presentation, I said I was going to tell you guys the best vehicle to do these things in. And that to me is the best vehicle, the solo Roth, as opposed to just the Roth IRA, because of the contribution limits being so much higher. As I said, for my example, in the cannabis field, you're not going to make a lot of people happy walking up to them, telling them they have $6,000 to invest. But when your contribution limits start getting up into the 60,000s and you have 1 or 2 years, I'm in the middle of a capital raise for good lettuce, and we're taking investors 25,000, 100,000, so that's $60,000 to play with. Then investors are happy. $6,000, there are companies that are smaller, dispensaries and things of that nature that would also want that money, but a solo 401k Roth is definitely the most attractive vehicle to amass the majority of these types of low cost basis investment.
Perfect. Thank you. Then I think this is a clarification for the IRA to note. If that's a clarification for the earlier question, I think that's still a little bit vague for me. If you'd like to try to clarify it a little bit more, or email me or Charles the question, I'm sure Charles would be happy to answer, and not myself. I would be happy to answer as well.
Right.
So next question: custodial account SEP. All ownership of the membership interest in a self-directed LLC are owned by the SEP account, not me, the individual. Can the manager, me, execute contracts and do more than just administrative work?
So no, I was gonna say number B, to show me not paying attention. Letter B, letter B of the disqualified persons list is it's the end of the presentation, I apologize. Fiduciaries over the IRAs are also disqualified persons. So you are the manager of your SEP. You are the fiduciary of your SEP. And as a result of that, you cannot, even though you may not be the owner of the actual entity, you're the person with final say over the way the SEP invests. So you would be subject to the same restrictions.
Thanks for that, Charles. Next question. Have you ever heard of anyone, any IRA company anywhere ever receiving any IRS penalty for being the manager, an LLC owner 100% by his IRA?
I want to read that again myself.
Yeah, I think I would need to read that again too.
Have you ever heard of anyone at any IRA company? So I'm assuming you mean, have I ever heard of anyone who has an IRA, a company owned inside their IRA, receiving an IRS penalty for being the manager of the LLC, an LLC owner? Yes. I mean, the IRC, if you go to Notice 2004-8, there are some hyperlinks inside of that IRS website page that talks about listed transactions and self-dealing. That is where you're running it into running afoul at, self-dealing. And I will say this, and I could be making a serious assumption, but it feels like this is the same person asking the question. And I'm just wondering if you feel like I'm giving you information that may make something that you've done look bad, or bring it up to a point where you may feel like I'm telling you you're running afoul with the IRS. I am a firm believer in pushing the tax envelope. I say more power to you. The IRS and the tax system is an honor code system, and you can do anything you want to do. I have friends of mine who have land easements, even though land easements are now listed transactions. I have friends of mine who have done installment sales, even though installment sales are now listed transactions. All that means is that the IRS scrutinizes them more, and you're more subject to be audited. It doesn't mean don't do it. It means that if you have an appetite and you're willing, the same way you're asking the question here repeatedly, if you're willing to go in front of a judge with your attorney and challenge their understanding of it, I would say, have your day in court.
Yeah, and I'll add to that, if you're getting to that point, and you have access to an attorney, I'd say consult them as well to see what their understanding or interpretation of it could be as well.
Yeah, definitely an attorney would know more than me. I will defer to that. I am not a lawyer. Perfect.
Another question coming in. I think we'll wrap up with these last two questions. The next question is: a startup has initiated a fundraise through the use of a promissory note with stock awards at the end of the term. Can I invest with separate agreements, a portion for my S Corp and another portion in my solo Roth 401k associated with my other company?
Is the startup under your control? Are you considered a disqualified person in relationship to that startup? If this is a third party's startup, then it's under that green light, go for it list of transactions. If this is from a lineal descendant, an ancestor, a spouse, a person who owns 10% more of the entity, and that's you, then the answer would be no. It's pretty clear cut in that regard. The fact that, so we actually are using promissory notes, we're using convertible notes for our capital raise. So people aren't actually buying ownership, they're buying debt that will eventually turn into equity. And if I were to do it at this point, I would be a disqualified person. But there are people who I had solicited for investments who they're not related to me. They're either clients of mine or people I went to college with who watch my show. And they're like, hey, I would do that. I take a flyer on that for $10,000 and see what happens. And they have no worry of running afoul with the IRS code because they're not on the disqualified person list because they're not related in any way, shape, or form to any of the people who are in management or ownership of the entity. So my question for you would be, are you asking if it's your company? I think that's the starting point. And solo 401k, Mark, is the final question. It does solve some issues. It solves the quantity issue. It solves the ability to invest more because the contribution limits, of course, are high.
Yes. Perfect. So I think that's a good portion to end it. I don't see any more questions coming in, but if any more questions do arise in your head for anybody currently in this presentation or anybody listening to this after the fact, whenever it may be, again, I highly suggest that you reach out to Charles. Charles, maybe if you want to read off your contact information one more time for the attendees and the future listeners, that would be great.
I appreciate that.
And then I'll list my contact information if you have any questions about Camaplan afterwards. Charles?
So I am the founder and CEO of a financial planning and literacy firm called Wealth Our Way. If you want to reach me there, the email address is tank, like an army tank, TANK, at wealthourway.com. If you look at my assistant's picture at the bottom of the screen, Wealth Our Way, the way it's spelled out, is the email domain name. Tank at wealthourway.com. I'm also the chief financial officer of a startup cultivation and manufacturing cannabis company in the state of New Jersey. And if you want to ask any questions about how cannabis would fit into any of these particular vehicles, purely on an informational question and answer, my email address at Good Lettuce is tank, TANK, at good, GOOD, lettuce, LETTUCE.com.
Perfect. Thank you. And to add to that, if you have any questions about Camaplan, my name is William Mucker. I'm a client executive with Camaplan, and you can reach me at info, INFO, at camaplan.com. And Charles, I want to thank you one more time for the wealth of information you provided today. And I hope you and everybody else in this presentation and anybody watching in the future have a great rest of your days.
Thank you, Will, for having us. We appreciate you. And thank you, Renee, for your assistance.
Thank you.
Thanks, Renee. Take care.
Thank you. Bye-bye.